Welcome to Finance Deep Dive. We're going to talk about something huge today, the US dollar. When it gets stronger, it's not just a headline for Wall Street. It sends these massive, often invisible shockwaves across the entire globe. And that's what we're digging into.
So that brings us to the big question, right? Why does a strong dollar make the rest of the world so nervous? I mean, on the surface, strong sounds good. But trust me, it is way more complicated than it looks.
And really, the answer is both simple and incredibly powerful. The dollar, well, it's not just another currency. It is the very heart of the entire international financial system. Nothing else even comes close.
All right, let's break this down. To really understand its power, we have to look at what the dollar actually does on the world stage. Okay, so think of the dollar's power like a three-legged stool. It's super stable because of these three pillars. First, it's the world's top reserve currency. That means central banks everywhere, from Tokyo to London, are holding piles of dollars for a rainy day. Second, it's how the world does business. Most global trade, from cars to computers, is bought and sold in dollars. And third, it's the benchmark for all the big stuff, like oil. You put those three together, and you've got the bedrock of the entire world economy.
So let's look at the first ripple effect. This is the one that you and I can feel most directly, how goods and money actually move.
And what's so interesting here is that it's a totally two-sided coin. So if you're in the US, imports get cheaper. Awesome for consumers, right? But if you're a US company trying to sell your stuff overseas, it just got more expensive for your customers. Now, flip that around. For every other country, their ability to buy things from the rest of the world just got weaker. It kind of puts a damper on global trade as a whole.
Now, that whole trade thing, that's a big deal. But honestly, it's just the tip of the iceberg. The real danger, the hidden danger, is when we start talking about debt. Okay, so to get this, you have to understand one key idea. A ton of borrowing around the world, especially in emerging markets, isn't done in the local currency. Nope, companies and even governments borrow in US dollars. Why? Because it's stable and everyone accepts it.
Let's paint a picture here. Imagine a company, let's say in Brazil or Thailand, takes out a big loan, 100 million US dollars. On paper, at that moment, the numbers work. It's all good. But then, something happens completely outside of their control. Maybe the US Federal Reserve hikes interest rates, and boom, the dollar shoots up in value. And here's the killer. That same $100 million loan, they still owe $100 million. But now, they have to come up with 20% more of their own local currency just to make the payment. The debt didn't grow, but the cost to repay it just exploded, literally overnight. And this isn't just some numbers game on a spreadsheet. We're talking about brutal, real-world consequences. All of a sudden, there's less money for new projects, for hiring, for growth. People have less to spend. And if enough companies can't pay their loans back, well, that's how you get a full-blown financial crisis. Okay, so that's the debt squeeze, but the chain reaction doesn't stop there. The next thing that happens is a massive capital drain. We're going to follow the money. A strong dollar acts like this giant, powerful magnet for global capital. Think about it. If the US economy looks strong and you can get a better, safer return on your money there, where are you going to put it? Investors start pulling their money out of other countries and pouring it into US assets. This drains cash from those emerging markets right at the moment they need it the most.
And you know what? This whole thing even finds its way to your local grocery store or gas station. Because all the big, essential commodities that the world runs on, we're talking oil, metals, agricultural stuff like wheat and soy, it's all priced in US dollars.
So here's the bottom line on that. When the dollar gets stronger, the price of these absolute essentials goes up for everybody else in the world. And that's a direct hit. It can drive inflation and put a major squeeze on family budgets everywhere.
So when you put this all together, what's the big picture? What's the global bottom line here? Yeah, this quote really hits the nail on the head. A strong dollar can be a major headwind for the global economy. It's this core tension, you see. It might signal that the US economy is doing well, but that very strength can act like a brake on growth for pretty much everyone else.
And that right there is the fundamental paradox of the whole system. The dollar is both a sign of US strength and a source of global instability. The very thing that looks like stability in one place creates chaos everywhere else. It's wild.
Which leaves us with one last big question to chew on. As long as the dollar is king, is this just the way it has to be? Will a strong dollar always mean a weaker world?
If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.